everyone, welcome back to the winning characteristics video with Ray from Traderline. And today we'll be covering APP's Digital Turbine Inc., which is now shaping back up here in 2021 after a monster run in 2020. So we've got a lot to discuss here, specifically on high volume closes, on those gap ups here on earnings. And there's a lot to learn from the stock chart. It's a great one to study. So if you're interested in all the components, the characteristics that we talk about in this video, go ahead and check out Leadership Blueprints down below in the description to really get a crash course on how to understand how we interpret stock charts. But with that said, Ray, let's get started and talk about apps and not only discuss a chart, but also talk about routines and how to catch a monster winner like this in 2020.
So yeah, just like we have been doing with other videos, and what we're going to be doing in this video is to figure out a way to catch a monster like this that basically went from $8 to $100 in a year. But usually, things in the market are not as as good as 2020 was, and these sort of runs usually take 3 to 4 years time. But 2020 was, for us, was sort of in the markets, was sort of squished down, and there's a lot of breadth expansion in the markets. Regardless of that, what's important and what we've been discussing in this series is to make sure that we have habits, routines, things that we look for in the markets that repeat themselves on winning stocks again and again and again, so that our trading is sort of, it has a method to it. It has a set routine and a set of characteristics that we look for, that we know that winning stocks show again and again in the markets. So with apps, what we're going to be doing is we're going to pick it up at June 2020. And this particular day, when it gapped up in the markets, and the volume on that particular day was 18 million, give or take. Now, one of the first things that makes this volume very important is the fact that this was the highest in over a year, right? So if we look at, this is the last June, so this is June 2019, and this particular stock never saw such volume for the past year. So what we call that is HV, highest volume in 1 year. And then the other thing that we look for is a high closing range, which is what apps did on this particular day. So this characteristic in and of itself, if you just take this and do a historical study on it, you will see that young stocks in the market tend to exhibit this. A recent example you could go back and is relevant to current conditions is AEHR. The stock's gone from about $5 to $10, and then now just recently today gapped up post earnings and is now trading in the 15s. So younger stocks will exhibit these characteristics when they're trading in the teens, and that's what makes them winners, because the institutions are basically picking up the story, future estimates, future growth, whatever you want to call it, whatever it is, it all boils down to the potential of that particular stock. And the institutions are basically saying this stock has a lot of potential because they're associating 18 million volume, which is the highest in over a year. So traders at, TL Private or, have made just this particular characteristic their sole source of income in the markets, where they look for these, and when they see these, they really focus in on them. It's on their focus list, and they try to extract an income out of such names. So if you're in the markets and you're looking for lack of a better word, a pattern or a characteristic that you could constantly eye and then make that a source of income, this would be one of the most obvious ones in the markets, which we call visible accumulation, because it's right there on the charts. There's not, nobody's really hiding it. And what this volume means is the fact that it was the highest in over a year. Is the street may be caught off guard, right? People like to say that, or there's a catalyst that wasn't expected, but now is there, that's causing that volume. But something's just happened that wasn't happening or wasn't expected in this area while it was trading. So when a stock does this, the story, whatever you want to call it, basically resets at this particular point. So anything to the left at that point becomes a little less relevant other than the character of the stock. But everything after that point, you have to judge the character after this particular gap up day. So I felt, we spend some time to just talk about this particular characteristic, which I feel is important. And especially when you're in a consistency phase, what you want to do is you want to master about 1 to 2, maybe 3 setups in the market. And then you have to make those setups sources of income for you when you're in the consistency phase. So the only goal in consistency phase is to get to profitability as soon as you can, as fast as you can, so that then you could go out and sort of master, other things in the market, and then slowly, focus on performance eventually. So I guess what I'm going to do now is sort of zoom in a little bit so that you guys can see a chart a little bit better. Richard, feel free to add something while I do that.
Sure. And while you're doing that, I just figured I'd add there's a ton of examples of high volume gap ups. Tesla in 2019 is pretty textbook. It not only had very high volume on that first gap up day, but also had follow on volume, which is something we look for. And most recently here in 2021, we've seen stocks like AMBA really come alive, AEHR, as Ray mentioned, as well as the recent video we did, AFRM, really great video. We go over a lot of these same concepts, and I'll link that down below in the description as well. It should be popping up to watch after this one. But yeah, there's a very clear sign of visible accumulation. This is really something that institutions can't really hide their buying, and normal retail traders can't contribute 18 million shares. Those are institutions who have decided this story has really changed and are now looking to acquire shares. And that buying doesn't just happen on one day, because institutions can't establish a full position like retail traders can just in one day. So they have to buy and slowly accumulate over the course of weeks and months, which is really what creates these trends in the market that we see in a stock chart like with apps.
So once you have something like this on radar, so what I get traders doing is, these days, what I'm trying to do, as I've mentioned in previous videos, is I want to get in on day one. Now, depending on the level of experience, how you've studied this particular characteristic, have you gone back and collected 600 examples, you have them printed, and you know exactly what situations could happen. That's how you get into these on day ones, and that's what I'm doing at the moment. Let's say you could wait and look at these for day 2, right? After this happens, you scan at the end of the day, you put this on your gappers watch list, and now you start watching for what is the entry area going to be, right? What's your risk level going to be, and what makes sense? How do you build what we call a recipe, right? Or evidence, so that you can position in such a stock after it's shown this characteristic. Because after this, everybody knows, right? That this is visible accumulation. It has high closing rate and storage change. I think EPS estimates were triple digits on this particular name. It had everything. But at this point, what we want to now sort of do is define risk and where risk is going to be for this particular chart. So one of the things is to have the high volume close area alerted, which is basically the $9 mark on this particular name. So if you just keep this alerted, it's going to keep, if the stock is above this area, that's a positive. If the stock's below this area, is it holding the gap low, right? Those are the 2 points of interest. And in this particular case, well, the market came in, the stock came into the, the gap update area, does a test of its first test of the 10-day after gapping up, and it holds that particular test. So that's usually, a fairly good sign that the stock is, under some sort of accumulation. And it was basically this day that caused, the market influence this particular gap down on apps. So after that, so HVC is your first entry point, potential entry point that you could, define your risk. The 10 DMA is basically your second one. When you get that first test of the 10 DMA, that's another one. And then the third one that we look for is basically whole number respect for certain levels in this area after the stock gaps up, which we don't get until this sort of $1.10 area
Hmm.
on this particular stock before it runs to 14 bucks. So just to recap, the HVC becomes really important with this, which is the high volume close, right? That area becomes important. It's almost as if above it, you're good, below it, you know, you want to then look at the 10-day if it's below that area. The other thing is how it acts when the market is down becomes really important. Is this really real accumulation that happened on that day? If it is, the stock is not going to make any excuses in the markets. If it isn't, what we would have seen is just it would cater down, and then basically it would be this bar, but would become a one-off event. So
Hmm.
what's important in what I just said is how it acts on down days. How it acts on down days becomes really important with these young stocks that are trading at 8-9 bucks, because these sort of stocks, if they're going to double and triple, institutions are going to step in on down days in the markets and really accumulate or support that stock. And again, a recent example we just saw with that was AEHR. While the market was drifting in, it continued holding that $5 level after it saw 130 million in volume, which was the highest ever that it's ever seen, right? And then after that, it ran up all the way to 15 bucks. So the similar story here, how things act on a down day on these young, lower price stocks is very important for you to understand or gauge that. Is this volume accumulation, or is this volume just a one-off and the stock just goes down and never sees 9 bucks again? So
Do you want to bring up the chart of AEHR real quick, just to show them what you're talking about?
okay, so with AEHR, what we see is we see that big volume that came in on this particular stock with about 60 million, and then follow through volume with 120 million. Now, a lot of stocks see such actions, especially in the biotech space. You'll see tickers that show such action, but only to just go dormant and do nothing for a very long time. What's the difference is you want to know how these stocks are acting while the market is drifting lower. And those down days, as you know, how do they respond on down days? And
Hmm.
you'll see if you go back and really study this on a granular level, is AEHR was clearly supported and never broke below that $5 level, especially on down days in the markets. And that's what basically what that's telling me is these bars and these volume bars are not one-off events. They're actually real accumulation for the stock. And maybe something has happened with respect to the story, the potential, whatever the future estimates, whatever you want to label it, something's happened. And then when the stock really gets up and out of there, this accumulation really now shows as, oh, this was obvious. So what I'm trying to get at is those down days after the gap up become very important for you to gauge if this is accumulation or it's distribution. So let's hop on back to apps and continue that one.
Hmm.
So with apps, I mean, one of the most obvious spots that I see is when the market goes into this area where we're sort of drifting down in the markets, we see a clear RS
Hmm.
zone, right? Where um, apps is outperforming the markets while the market is going or drifting down. That sort of action can only be created if a stock is being accumulated in the markets. There's no other force in the markets that can sort of accomplish that for us. So we get that run while the market is sort of off of its highs and sort of figuring out things. And then when we get a rally, we sort of go into consolidation mode with likely what is earnings that were coming up for this particular stock. So this RS alone, I mean, this RS zone alone shows you that there's some sort of accumulation on this particular name. And basically, it's a clear sign that this particular day was just more than a one-off day for this particular stock. Now, what we get after the fact is basically follow through volume, which I'm assuming is on another earnings um, related event or maybe estimates or whatever the case might be. But this volume again was the highest positive volume in over a year. and the highest volume since the last earnings cycle, right? And we get a good closing range on apps. And then on this one, again, it's the same, and like it's the same blueprint. The
Hmm.
blueprint is you take a look at this HBC area, you make sure that that particular area is holding. We get a rally off of that area because the market's already rocking, right? So there's likely breadth expansion in the markets. And then we get a rally from about the 22 area to the 29 area. Now, what I like about this particular name is when the markets get turbulent again in this zone, it holds. This is where the whole number concept comes into play, is it holds that $1.20 area, and it comes into that gap up day, holds that $1.20 area, and we see a rising RS line while we see a declining market again. That again is the same thing. It's the RS zone that tells you that there's net accumulation in this name, and then we see a rally up and out of that. And then if we just keep going, this one, I mean, it holds that 25 mark after holding that 20 mark. Now it becomes a little bit volatile, right? It's hard to see if you get two closes below the 21, that's your sell rule, right? You break that, it comes back down, you avoid all of this, but then that gives you, you know, the mind clarity to sort of pick up the stock maybe into the 35s when it starts respecting the 35s, or sort of keeps it on your radar because you avoided that severe drawdown from basically the high 30s into the low or mid 20s. So let's not spend, I mean, too much time on talking about last year. So this sort of run, the concepts apply. I mean, that's what's key, right?
Hmm.
Duplicating or repetitive. These are, you know, these characteristics are repeating themselves. So this volume, it's the same characteristic, same DCR, same HVC, right? It would make your gappers list. You look for RS zones, and then you figure out your, you know, risk or entry areas. It holds that 20 area, rallies to 42. That gives you a double. And that's
Hmm.
just how 2020 was. If you got it right, you get a double at a minimum. So
And
uh,
one more spot I want to talk about before we move on, just really quickly. Um, After it showed nice RS here, let me get my annotation tool here. Once it showed RS right in the zone here, it really gets tight against the really short-term moving averages here, the 23 exponential and 21 day. And then you have a nice buy on strength right here before it runs before earnings. So I just want to mention that this tightness where we've got no volume, suggesting that there's no real sellers here, and then this volume coming in before earnings gives you that nice push, that nice cushion, so you could potentially hold it through this earnings event and benefit from that gap up. So I thought I'd mention that entry point as well.
so if we keep going, this run was probably one of the best runs if you caught it from the get-go, which is this particular characteristic. And you basically, I mean, it never gives you a really big reason to sell your position. Maybe at this, I mean, if you bought it at $9 and maybe you added into this and it held above the 20, you got to give it two closes below the 65. It never does that.
Hmm.
So this one just kept going and going and going until we get to this area, which things change a little bit in the Feb of 2020, which we all know already is where growth sort of
Took a hit.
uh, took a hit and started basing, right? So at this point, what happened was the retraces that were 61 to 49, which were fairly reasonable into the 21 day, became 100 to 61. That these became very large swings for the
Wide and
stock.
loose, as they say.
Wide, right, wide and loose swings, and then KMAs are all caught up. So your KMAs, which are basically these moving averages, they're all caught up. And then at this point, it becomes fairly obvious the stock is going to base. So it was down when the market was down. It was up when the market was up. There's really no RS zones, right? There's no evidence of significant accumulation in this area because the market, you know, the market was swinging, the stock is swinging. What we want is when the market is swinging for the stock to be up when the market is up, but hold when the market's down, be up even more when the market's up, and then hold the market's down. That's how we get this sort of move out of stocks, right? So At this point, I mean, it was basing that these sort of ranges fall out of everybody's risk appetite, even though, we do try to, as traders, try to trade this action and think that something that's gone from $8 to 100 is going to go from 100 to, I don't know, 150, but that's likely not the case. The stock enters a fairly deep base at this point. And then what we've discussed in last videos is we're basically at this point looking for volume anchors,
Hmm.
right? Like we discussed in the last video, we're looking, now it's about the anatomy of the base. When you're trading within the base, your tactics are completely different than, say, if you're trading at HVC areas. This is a whole different ball game. You need a different set of tools, a different set of eyes or interpretation um, of the action within the base. Whereas this action was basically the stocks making 52 week highs constantly. That's a different type of analysis, because at that point you're just trying to manage your risk versus the KMAs and try to ride it up. So once we get into the base, like we talked about in previous videos, we're looking for volume anchors or some sort of evidence that something is about to change in this name. One of the things that we look for is the KMA launch pads, which it's sort of formed in this area, right? Price came back in on fairly below average volume. We try to rally up and out, but then this day comes in and someone says not yet for this particular name. So maybe if you squeezed in a trade here with this KMA launchpad concept, you would have gotten out fairly unharmed if your entry was proper, right, or flat, maybe with even a little bit of gain. But again, someone says now is not the time, and we continue to enter this deep base from about 102 down to the 50s for this particular name. What's interesting is we do, as the action goes on, there's really no evidence when we're below the 50-day or living below the 50-day. There really is no point to be putting on large positions. So if you're trading it below the KMA here, below the KMA here, you're basically avoiding the opposite of what the stock was doing back from June to from $8 to $100, right? Which was above all the KMAs. Now it's below all the KMAs, and you're just avoiding these down drifts and letting someone step up so that we can have the same evidence that we had from an 8 to 100 area show up again, maybe in the 50s, maybe in the 60s, but we have to wait. And we did get that recently in September.
Hmm.
So this particular first volume candle was the addition to the mid cap index for the S&P mid cap edition. So this particular name was added to that S&P mid cap. That was the reason for this first volume stick. The stock used that as an excuse to gap up as positive news or some catalyst came in, and it held fairly well subsequently after that gap up. Now the second one was, I believe, a analyst upgrade for apps. So an analyst basically upgraded their estimates, whatever the case might be, and we get another 16 million volume stick for this particular name. So at this point, there's new evidence that's building, right? These are volume anchors that we talked about. These are basically volume anchors within the base. And we get about 30 million in volume, which I basically call the Twin Towers. And everything from this point on sort of resets, because this takes care of all this supply, whatever you want to call it, the basing period that was happening to the left of it. And if we just zoom out a little bit, what we see is that these two volume bars were the highest since this particular earnings cycle, right? So this volume bar, if you're blaming this on an index addition, but this particular one was on a, an analyst upgrading the stock, whatever the case might be, these two volume bars were the highest that the stock has seen since the $9 range. So at this point, what I see, my analysis, again, sort of resets at this point. I want to see, and we'll see that again if we just zoom in a little bit. is we start to see the stock exhibit RS recently. So
Hmm.
the market is going down, right? This past week, the market was going down. Going to the right, we basically see the market is again retracing while the RS line on apps is rising. That's after these two particular volume sticks came in, and the stock is again what we call is building a RS zone. What does that tell us? That tells us that it's under accumulation. Now, this might sound like you just heard the video, you just heard me say this earlier in the video, but this is the same recipe that's building again. Is
Hmm.
that these particular spots become key? They're HVC spots. You have to basically define a risk. We're starting to build a launch pad on this particular name. And then it uses, so this particular day became key. It came down on below average volume while the NASDAQ was down 3% on
Hmm.
Monday. And then as soon as the market lifted, it respected that 60 area and we got a zip from 60 to about 74 for this stock. So now we have a RS zone. We have volume anchors, which were the highest since the last earnings cycle. For this particular name, we have a launch pad, and it's the same recipe that's building for this particular name. Richard, do you want to talk about that whole moving average that you put on your RS line a little bit? Maybe cover that for folks.
Yeah, sure. So on my charts in TC2000, what I've done is added a moving average to the relative strength line, and this is something that I was taught way back during my classes with Dr. Wish. He had the 30-day moving average on it, and basically it shows you the trend of the moving average, just like how we can gauge the trend of a stock's price action using a moving average. We can basically tell whether over a period the RS line is outperforming or underperforming, and here pretty much since that relative strength line. It's pretty much what Ray just drew there. This stock has been outperforming since that high volume gap up. So something has changed with the relative strength. And one more thing I wanted to add about this entire base is, as traders, we basically want to leverage both time and money. And we don't. Our objective is not to sit through this entire 5-6 month base where the stock is extremely volatile. We want to enter at a spot where something has changed and there's a high probability of a large directional move to the upside if we're going long, and down to the downside if we're going short. And until that high volume close, until that new volume, new life came to the stock, this base was just kind of going up and down. We saw a large drawdown after earnings, down 30%. So it was very hard to define your risk as well as get in to a spot where the stock is starting to move up the right hand side of this base and potentially start a new uptrend like we saw in 2020. So yeah, those were a few things that I wanted to add about apps. And now we've got a little bit of a launch pad, as Ray mentioned, and the potential start to a very early uptrend within this base. Maybe we get a push up here towards this 80 mark, start to see a consolidation, a little base within a base. But I think if this turns out to be a really long-term winner, as the estimates are saying, there'll be plenty of opportunities to get into the stock, and maybe now with this high volume close, that new life really starts the new uptrend.
Just to add to what Richard's saying with that, we want to leverage time. So you have to decide if you are going to be a trader or a investor. When
Right.
I see traders sort of do a little bit of both when they're down on the name, they bought it at 66 and now they're suffering. They become investors all of a sudden, right? And they hope that this one comes out and then they probably sell at break even. That sort of mindset or strategy, you got to pick a side. You have to be either a really, 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 really good trader or you have to be a really good investor. Yes, I know traders that do both, but they have separate accounts for those. But the best way is to not, buy this at 80. You catch a big down day and then you just sit there like a deer in the headlights and become an investor on this particular name. That sort of mindset, that sort of approach is not going to net you any, at the end of the day, if you're doing this, the goal is to see your equity curve spike and make big progress while the market comes down for your equity curve to slightly see a downdrift. And then when the market goes up, you see a big progress. Again,
Mhm.
if you're not seeing that, you have problems that you need to be fixing in the markets. So if you're switching hats again and again, depending on how the name trades, and you sort of make a thing that you bought at 80 that's now trading at 60, now it's in my investment portfolio, I'll take a look at it later. At that point, what you're doing is you're hoping that it comes back. And recent years, the market in say 2020 and even 2021 has been really, really, really nice to people, but it's not always going to be that nice, because some of these companies that run from 8 to 100 go into basing periods. If you just look at Cisco or IBM or whatever you want to, pick on, they go into like 30-year bases. And are you going to sit there and be an investor while your, hair turns white and the name is in a 30-year base? I don't think so. So always be really good at something, and pick a side. If you want to be an investor, you should be buying within the base or buying at spots where where the drawdown is so severe that you've historically studied that such stocks, when they come down 50 to 52% off of highs, usually see some sort of bounce in them. That's an investment approach to be taken. If you're a trader, you want to see instant progress, because you want to see this sort of spike in your equity curve. A name that wants to win in the markets is never going to make any excuses, right? So just like apps recently, it's holding the key areas while the market lifts even a little. It's zipping to new consolidation highs. So it's really, it's changing its character, and it's really trying to say that, now is the time to be buying me, because my character's changed. There's evidence on the charts this was the same evidence that we saw at $8 is now what we're seeing at $58, right?
Mm-hmm.
So I feel, I saw a few, when I see these examples where traders, put their investment hat on because they're down 20% on a name, it just takes a toll on you mentally. And is it really worth it? Because at the end of the day, if you're not making money, none of this is worth it. So make sure you're, very truthful to yourself, because I feel that's very important.
Mm-hmm.
Make sure, you're actually addressing your problems in the market, because if you're not addressing those, then you're going to be digging yourself a hole, and it's going to be a bunch of waste of time. And eventually, that stat is going to come and haunt you, which is 90% of the traders don't make it in the markets. So I think that's a good note to end at.
Yeah, we'll leave it there. I hope you guys enjoy this video. If you did, go ahead and leave a like down below. It just takes a second out of your time, and it helps me a lot, helps out the channel. And if you enjoy this video, go ahead and check out the others in the series. I'll have basically the AFRM video, UPST, link down below in the description, and also subscribe to the channel so you don't miss any future ones. But with that, thanks again for watching. I hope you guys enjoyed, and we'll see you guys in future videos. Thanks.